One man controls more of your daily life than Jeff Bezos, Elon Musk, and Warren Buffett combined. Steven Schwartzman owns the apartment you rent, the hotel where you vacation, the warehouse storing your Amazon packages, the office building where you work, and even the music rights to songs you stream. His company, Blackstone, manages $1.2 trillion in assets, more than the GDP of most countries. That's enough money to buy Apple, Microsoft, and Google simultaneously, with billions left over. But what nobody knows is how a kid from suburban Philadelphia, who started with $400,000 in borrowed money, built the most powerful empire in modern history by perfecting one devastating strategy: buying everything essential to human survival, then slowly squeezing every penny out of it. While tech billionaires grab headlines with rockets and social media, Schwartzman quietly purchased the foundation of American life itself. Your morning coffee shop sits in his building. Your kids' student housing belongs to him. The mobile home park your grandparents retire to, he owns that too. Even the funeral home where you'll eventually be buried pays rent to Blackstone. The numbers are staggering. Blackstone controls 300,000 residential units across America. They own 149,000 apartment units, 63,000 single-family homes, and 13,000 mobile home lots. Their real estate portfolio spans 12,500 properties worldwide. Their private equity arm controls 250 companies that employ millions of people. This isn't just about wealth, it's about power. When one company owns the basic necessities of life, they control the price of living itself. United Nations investigators have called Blackstone's practices a threat to human rights. Housing advocates label Steven Schwartzman a modern robber baron. Even lawmakers who rarely agree on anything have united to investigate his empire's impact on American families. Yet Schwartzman keeps winning. His personal fortune exceeded $37 billion in 2024, making him richer than most sovereign nations. He hosts world leaders at his $37 million Park Avenue penthouse. He influences elections with $27 million in political contributions. Presidents call him for economic advice. This is the story of how one firm didn't just predict the future. They bought it piece by piece, until they owned the very ground beneath your feet. And what they did next changed capitalism forever. Chapter 1. Humble Beginnings. In 1984, Steven Schwartzman faced the most consequential decision of his career while sitting in his corner office at Lehman Brothers, one of Wall Street's most prestigious investment banks. At 37, he had already achieved remarkable success as the head of global mergers and acquisitions, earning millions in fees for orchestrating complex corporate deals. But Schwartzman was about to throw it all away for a partnership with a man twice his age and an idea that seemed impossibly ambitious. The decision crystallized during a tense meeting with Lehman's leadership about the firm's future. American Express had just agreed to acquire Lehman Brothers for $360 million, and Schwartzman found himself caught in corporate politics that disgusted him. Senior executives were maneuvering for positions in the new structure, while middle managers worried about layoffs. The collegial culture that had made Lehman special was evaporating in real time. Schwartzman had been the point person negotiating Lehman's sale to American Express, which gave him intimate knowledge of how the deal would reshape the firm. Under American Express ownership, Lehman would become a more bureaucratic, risk-averse operation, focused on steady profits rather than bold deal-making. For someone who thrived on complexity and innovation, this felt like professional death. The catalyst for action came through his relationship with Peter Peterson, Lehman's former chairman, who had been pushed out during the merger negotiations. Peterson was a legendary figure on Wall Street, former Commerce Secretary under Richard Nixon, former CEO of Bell & Howell, and one of the most respected names in finance. Despite being 58 years old with nothing left to prove, Peterson was hungry to build something new. Their conversations revealed complementary skills and shared frustrations. Peterson brought gravitas, political connections, and a track record of building large organizations. Schwartzman contributed operational expertise, client relationships, and an encyclopedic knowledge of mergers and acquisitions. Both men were dissatisfied with the direction Wall Street was heading, toward larger, more bureaucratic institutions that prioritized stability over innovation. The specific opportunity they identified was private equity, a nascent industry dominated by a handful of small firms. In 1984, private equity meant buying struggling companies, improving their operations, and selling them for a profit. The model required substantial capital, operational expertise, and patience, qualities that traditional Wall Street firms couldn't provide due to their focus on quarterly earnings and risk management. Schwartzman and Peterson saw private equity as the perfect vehicle for their skills. Peterson's government experience and business relationships could open doors to major corporations and institutional investors. Schwartzman's M&A background gave him deep knowledge of company valuations and deal structures. Together, they could build a firm capable of handling larger, more complex transactions than existing private equity players. But starting their own firm meant enormous personal risk. Both men were walking away from seven-figure incomes at Lehman Brothers to launch a startup with uncertain prospects. Private equity was unproven as an institutional investment strategy. Most pension funds and university endowments had never heard of the concept, let alone allocated capital to it. The financial barriers were substantial. Launching a credible private equity firm required millions in operating capital before completing a single deal. They needed prestigious offices, experienced staff, sophisticated systems, and enough working capital to survive years without significant revenue. Neither man wanted to appear desperate or undercapitalized when approaching potential investors. Their personal situations added complexity to the decision. Peterson was nearing traditional retirement age and risking his reputation as a distinguished public servant. Schwartzman was at the peak of his earning potential at Lehman, with young children and substantial lifestyle commitments. Starting over meant years of uncertainty and potentially devastating financial losses. The breakthrough came through a handshake agreement that reflected their mutual respect and complementary skills. Peterson would serve as chairman, lending credibility and opening doors to major investors. Schwartzman would run day-to-day operations, source deals, and manage client relationships. They would split ownership equally and pool their personal resources to fund the startup phase. Their timing proved fortuitous for reasons they couldn't fully appreciate at the time. The mid-1980s marked the beginning of a massive shift in how institutional investors managed their portfolios. University endowments were growing rapidly due to successful fundraising campaigns. Corporate pension funds were accumulating assets faster than traditional stock and bond markets could absorb. Foreign governments were creating sovereign wealth funds to manage oil revenues and trade surpluses. This created an enormous pool of capital seeking higher returns than traditional investments could provide. Private equity promised to fill that gap by investing in companies too small or complex for public markets, while generating returns superior to stocks and bonds. The opportunity was vast, but only for firms with enough scale and expertise to handle institutional-sized investments. Schwartzman and Peterson recognized that timing was crucial. Private equity was still small enough that early movers could establish dominant positions before competition intensified. But the window was closing as other Wall Street veterans noticed the opportunity and began planning their own firms. The final decision came down to their shared belief that they could build something unprecedented, a private equity firm with the scale and sophistication to compete with traditional investment banks while maintaining the entrepreneurial culture of a startup. Instead of being employees at a large institution, they would be owners of their own destiny. On a cold February day in 1985, Stephen Schwartzman and Peter Peterson signed the papers incorporating the Blackstone Group. They named it after Peterson's original surname, Petropoulos, which had been Americanized to Peterson when his Greek immigrant father sought to assimilate. Blackstone was the literal English translation of Petropoulos, connecting their new venture to Peterson's family heritage. Their initial capital was modest by today's standards, $400,000 in combined personal investments. They rented office space at 345 Park Avenue, hired 2 assistants, and began the long process of convincing institutional investors to trust them with hundreds of millions of dollars. Neither man fully understood what they were unleashing. Within 4 decades, their small partnership would grow into the largest alternative investment firm in history, controlling more assets than most sovereign nations and influencing everything from housing costs to corporate governance to global infrastructure development. But in February 1985, Schwartzman and Peterson were just two unemployed former Wall Street executives with an unproven idea and a tiny office. What happened next would transform not just their own lives, but the entire structure of global capitalism. Chapter 2: First Strike. The early months of 1985 tested Schwartzman and Peterson's resolve in ways they never anticipated. While their vision for Blackstone was bold, the reality of building a private equity firm from scratch proved brutally difficult. Major investors politely declined their requests for meetings. Promising deals fell through at the last minute. Even basic operations like hiring qualified staff became exercises in persuasion, as experienced professionals doubted whether two former Lehman executives could build a sustainable business. Schwartzman discovered that leaving the security of a major Wall Street firm meant losing access to the infrastructure that made complex deals possible. At Lehman, he could rely on teams of analysts, established relationships with investment banks, and sophisticated computer systems for financial modeling. At Blackstone, he was personally responsible for tasks that had previously been handled by support staff. Peterson, despite his impressive resume, found that his government connections didn't automatically translate into private sector opportunities. The financial pressure was immediate and intense. Their $400,000 in startup capital covered basic expenses for only a few months. Unlike traditional investment banks that generated revenue through fees and commissions, private equity firms required substantial capital before completing their first transaction. They needed to raise their first fund, identify suitable acquisition targets, negotiate complex purchases, and then spend years improving operations before realizing any profits. Their first major break came through Peterson's relationship with Prudential Insurance Company, one of America's largest institutional investors. Prudential was exploring alternative investments as a way to diversify beyond traditional stocks and bonds. Peterson's reputation as former Commerce Secretary provided credibility, while Schwartzman's M&A experience demonstrated operational competence. After months of presentations and due diligence, Prudential agreed to invest $100 million in Blackstone's first private equity fund. The Prudential commitment was transformative for several reasons beyond the obvious capital infusion. Having a respected institutional investor as their anchor client gave Blackstone credibility with other potential investors. More importantly, Prudential's investment professionals shared valuable insights about structuring private equity funds and managing institutional relationships. The partnership taught Schwartzman and Peterson lessons about investor relations that would prove crucial as they scaled their business. Their first acquisition target emerged from Schwartzman's network of corporate contacts developed during his Lehman Brothers years. USX Corporation, the former US Steel, was divesting non-core assets to focus on its primary steel business. Among the assets for sale was Unimax, a small company that manufactured steel products for the construction industry. While unglamorous, Unimax represented exactly the type of opportunity Schwartzman and Peterson sought. An undervalued business in a stable industry with potential for operational improvement. The Unimax acquisition tested every aspect of Blackstone's capabilities. Schwartzman led the financial analysis and negotiation, while Peterson managed investor relations and strategic oversight. They discovered that buying companies required skills beyond financial modeling, understanding manufacturing operations, evaluating management teams, assessing market dynamics, and projecting long-term industry trends. The deal structure reflected their cautious approach to their first major investment. They acquired Unimax for $32 million, financing the purchase through a combination of equity from their fund and debt secured by the company's assets. Rather than implementing aggressive changes immediately, they worked closely with existing management to identify improvement opportunities and develop implementation plans. What made the Unimax investment historically significant wasn't its size or profitability, but what it taught Schwartzman about the private equity model. Unlike public market investing, which relied on stock price appreciation, private equity created value through operational improvements, financial engineering, and strategic repositioning. Success required patience, operational expertise, and access to capital markets for eventual exit strategies. The operational challenges were immediate and educational. Unimax's manufacturing facilities needed equipment upgrades that required additional capital investment. The company's sales force was underperforming in key markets, necessitating new hiring and training programs. Financial controls were inadequate for institutional ownership standards, requiring implementation of sophisticated reporting systems. Schwartzman immersed himself in manufacturing details that he'd never encountered during his investment banking career. He spent days touring production facilities, analyzing efficiency metrics, and interviewing employees at all levels. The experience taught him that successful private equity investing required understanding businesses from the ground up, not just analyzing financial statements from corporate headquarters. The breakthrough came when Blackstone identified opportunities to expand Unimax's product line by leveraging relationships with USX's other subsidiaries. By redesigning certain products to meet specifications for larger construction projects, they could increase profit margins while gaining access to new customer segments. The strategy required modest capital investment but delivered substantial revenue growth within 18 months. Peterson's role evolved during this period, from figurehead to strategic advisor. His experience building large organizations proved invaluable as Blackstone developed systems for evaluating investments, managing portfolio companies, and reporting results to investors. He also maintained relationships with potential investors, while Schwartzman focused on deal execution and operational oversight. The timing of their entry into private equity proved remarkably fortuitous. The mid-1980s marked the beginning of a sustained period of economic growth, declining interest rates, and increasing availability of debt financing. These conditions were ideal for private equity strategies that relied on financial leverage to enhance returns. Companies with stable cash flows could support higher debt levels, while growing economies reduced default risks. More importantly, corporate America was undergoing fundamental changes that created numerous private equity opportunities. Large conglomerates were divesting non-core subsidiaries to focus on primary businesses. Family-owned companies were seeking exit strategies as founders approached retirement. Regulatory changes were making certain industries more attractive to private ownership. Schwartzman recognized that these trends represented a sustained opportunity rather than temporary market conditions. Unlike economic cycles that reversed every few years, structural changes in corporate ownership patterns would continue for decades. This insight informed Blackstone's long-term strategy of building capabilities to handle increasingly large and complex transactions. The Unimax experience also revealed the importance of exit strategies in private equity investing. Unlike public market investments that could be sold at any time, private equity investments required careful planning for eventual disposition. Schwartzman and Peterson spent considerable time developing relationships with investment banks, strategic buyers, and public market investors who could provide liquidity when appropriate. After 2 years of operational improvements and strategic repositioning, Blackstone sold Unimax to a larger manufacturing company for $65 million, nearly doubling their original investment. The transaction validated their investment approach while demonstrating Blackstone's ability to create value through active ownership rather than passive financial engineering. But more importantly, the Unimax success gave Schwartzman confidence that their partnership could tackle much larger and more complex opportunities. He began developing plans for Blackstone's second fund, which would target acquisitions in the hundreds of millions rather than tens of millions of dollars. Peterson was already thinking even bigger, envisioning Blackstone as a diversified investment firm capable of competing with established Wall Street players across multiple asset classes. The foundation was in place. Now they needed to execute on a scale that would establish Blackstone as a permanent force in global finance. Chapter 3. Going Public. By 2006, Blackstone had evolved far beyond Schwartzman and Peterson's original vision of a boutique private equity firm. Over 2 decades, they had systematically expanded into real estate, hedge funds, credit investing, and advisory services. Their assets under management approached $100 billion, making them one of the largest alternative investment firms in the world. But Schwartzman was contemplating a move that would fundamentally change Blackstone's trajectory. taking the company public through the largest private equity IPO in history. The decision to go public wasn't driven by capital needs or external pressure. Blackstone was generating enormous profits from management fees and carried interest payments. Their limited partners included sovereign wealth funds, pension systems, and university endowments with hundreds of billions in investable assets. The firm's reputation attracted the best talent in finance, while their track record secured access to the most attractive investment opportunities. Instead, Schwartzman saw the IPO as a strategic weapon for the next phase of competition in alternative investing. Going public would provide a permanent capital base that couldn't be withdrawn by limited partners. It would enable acquisitions of smaller investment firms while providing currency for attracting top talent. Most importantly, it would establish Blackstone's valuation at a level that reflected their true economic value rather than private market estimates. The timing appeared optimal for several interconnected reasons. Global markets were experiencing sustained growth with low volatility. Pension funds and sovereign wealth funds were allocating increasing percentages of their portfolios to alternative investments. Private equity returns were consistently outperforming public markets, creating demand for exposure to the asset class. Meanwhile, regulatory environments remained favorable to private equity operations. Schwartzman's analysis of public market conditions revealed a unique opportunity window. Investor appetite for financial services stocks was strong following years of bank consolidation and improved profitability. Private equity firms were generating consistent returns that compared favorably to traditional asset managers. Most importantly, the complexity of alternative investing meant that public investors couldn't easily replicate Blackstone's strategies on their own. The preparation process required fundamental changes to Blackstone's operations and disclosure practices. As a private partnership, they had maintained confidentiality about investment strategies, portfolio company performance, and internal financial metrics. Going public meant regular earnings reports, investor conference calls, and SEC oversight of their business practices. Every aspect of their operations would be subject to public scrutiny and regulatory compliance. Peterson, now in his 70s, initially expressed reservations about the IPO's complexity and ongoing obligations. He had spent decades building Blackstone's reputation through careful relationship management and discretionary decision-making. Public ownership meant accountability to thousands of shareholders with varying investment objectives and time horizons. The culture of patient long-term value creation might be compromised by quarterly earnings pressure. Schwartzman addressed these concerns by structuring the IPO to maintain control over Blackstone's strategic direction. Rather than selling traditional common stock, they would offer units in a limited partnership with limited voting rights. Blackstone's senior leadership would retain control over investment decisions, capital allocation, and operational matters. Public investors would share in economic returns without gaining operational influence. The mathematical framework for valuation proved challenging due to Blackstone's unique business model. Traditional financial companies could be valued based on assets under management, fee structures, and return on equity. But Blackstone generated income through multiple revenue streams with different risk profiles and growth trajectories. Management fees provided steady income, while carried interest payments created enormous upside potential, but with irregular timing. Their investment banking team, led by Morgan Stanley, ultimately settled on a valuation methodology that emphasized Blackstone's diversified revenue streams and superior long-term returns. Rather than comparing them to traditional asset managers, they positioned Blackstone as a unique alternative to direct private market investing. For institutional investors seeking private equity exposure without building internal capabilities, Blackstone stock offered liquid access to professionally managed alternative investments. The roadshow process revealed strong institutional demand for Blackstone shares. Insurance companies saw the stock as a way to participate in private equity returns without direct capital commitments. Pension funds could supplement their private allocations with liquid exposure. University endowments could gain immediate access to diversified alternative strategies while maintaining flexibility for other investment opportunities. But the roadshow also exposed concerns about Blackstone's business model and future prospects. Some investors questioned whether management fees justified public market valuations given the cyclical nature of private equity returns. Others worried about increased competition from banks and other financial institutions entering alternative investing. Regulatory risks related to tax treatment and systemic importance generated additional uncertainty. Schwartzman addressed these concerns by emphasizing Blackstone's competitive advantages and defensive characteristics. Their scale enabled access to deals unavailable to smaller competitors. Their diversification across asset classes reduced dependence on any single investment strategy. Their global footprint provided opportunities independent of U.S. market conditions. Most importantly, their track record demonstrated consistent outperformance across multiple market cycles. The pricing discussion revealed the delicate balance between maximizing proceeds and ensuring strong initial trading performance. Setting the price too high risked poor aftermarket performance that could damage Blackstone's reputation and limit future access to public capital markets. Pricing too low meant leaving substantial value on the table when the firm's private market valuation suggested higher levels. After extensive consultation with institutional investors and market analysis, they priced the IPO at $31 per share, valuing Blackstone at approximately $33 billion. This represented a modest discount to private market comparisons while providing room for positive price appreciation following the offering. The size of the deal, approximately $4 billion, made it one of the largest IPOs in U.S. history. The public debut on June 22, 2007, exceeded expectations on multiple dimensions. Trading volume was heavy but orderly, with shares closing at $35.06, a 13% premium to the offering price. The successful pricing and trading performance validated Blackstone's investment thesis, while providing substantial proceeds for expansion and diversification initiatives. For Schwartzman personally, the IPO represented the culmination of 20 years building Blackstone from a two-person startup into a global financial powerhouse. His stake in the public company was worth approximately $8 billion, establishing him among the wealthiest individuals in America. More importantly, the permanent capital base enabled long-term strategic planning without dependence on fundraising cycles. Peterson used the IPO as an opportunity to reduce his operational involvement while maintaining a significant economic interest. At 81, he had earned the right to step back from daily management while preserving his legacy as Blackstone's co-founder. His shares were worth approximately $1.9 billion, a remarkable return on his original investment of $200,000. The immediate aftermath of the IPO revealed both opportunities and challenges of public ownership. Blackstone gained access to public capital markets for debt and equity financing. Their stock provided acquisition currency for purchasing other investment firms. Public reporting enhanced their credibility with institutional clients and regulatory authorities. But public ownership also created new pressures and constraints. Quarterly earnings calls meant regular scrutiny of short-term performance metrics. Share price volatility affected employee compensation and retention, since equity-based packages were tied to stock performance. Regulatory attention increased as public companies faced different oversight than private partnerships. More fundamentally, the IPO marked Blackstone's transition from a private partnership focused on long-term value creation to a public company accountable to diverse shareholders with varying objectives. This evolution would shape every strategic decision going forward, as Schwartzman balanced the interests of limited partners, public shareholders, employees, and portfolio companies. The timing of the IPO, completed just months before the 2008 financial crisis, would prove both fortuitous and challenging in ways that Schwartzman couldn't fully anticipate. The permanent capital raised through public offering would provide stability during market turbulence, but their public profile would also attract scrutiny during a period when private equity faced unprecedented criticism. What neither Schwartzman nor the investment community fully understood was that the IPO represented just the beginning of Blackstone's transformation into something unprecedented in finance, a public-private hybrid with the resources to reshape entire sectors of the global economy. Chapter 4: Crisis Opportunity. The 2008 financial crisis arrived like a tsunami that swept away fortunes, institutions, and entire economic paradigms. As Lehman Brothers collapsed, Bear Stearns disappeared, and AIG teetered on bankruptcy, most of Wall Street focused on survival. But Stephen Schwarzman saw something different in the chaos, the greatest investment opportunity of his lifetime. While others retreated, Blackstone would advance, using the crisis to acquire assets at historic discounts and establish positions that would generate enormous returns for decades. The immediate aftermath of Lehman's September 15, 2008, bankruptcy filing created unprecedented dislocations across global financial markets. Credit markets froze as banks stopped lending to each other and businesses. Real estate values plummeted as mortgage financing disappeared and foreclosures accelerated. Public markets lost $7 trillion in value as panicked investors sold everything. Private equity firms that had thrived during the buyout boom suddenly faced their own liquidity crises as portfolio companies struggled and debt markets closed. For most investment firms, the crisis meant defense, preserving capital, managing existing investments, and waiting for stability to return. But Schwarzman recognized that severe market dislocations created opportunities for firms with patient capital and strong balance sheets. Assets that might trade for $100 during normal times were suddenly available for $30 or $40. The key was having the resources and conviction to act, while others remained paralyzed by fear. Blackstone's advantages during this period reflected decisions made years earlier that seemed prudent but not prescient at the time. Their diversification across private equity, real estate, hedge funds, and credit investing meant that poor performance in one area could be offset by opportunities in others. Their global footprint provided access to capital from sovereign wealth funds and pension systems that remained liquid while U.S. institutions faced constraints. Most importantly, their permanent capital base from the 2007 IPO meant they couldn't be forced to liquidate positions during the worst market conditions. The first major opportunity emerged in commercial real estate as property values collapsed and debt financing evaporated. Trophy office buildings in Manhattan that had sold for record prices in 2006 and 2007 were suddenly available at 40–50% discounts. Hotel properties, retail centers, and industrial facilities faced similar distress as owners couldn't refinance maturing debt or meet operating expenses with declining revenues. Schwarzman's real estate team, led by Jonathan Gray, had been preparing for exactly this scenario. During the 2005–2007 boom, they had largely avoided acquisitions, believing prices were unsustainably high. Instead, they raised capital and positioned themselves to deploy resources when opportunities improved. Their patience was now being rewarded with access to institutional quality properties at Depression-era prices. The strategy required not just capital, but operational expertise and market intelligence. Distressed real estate investing wasn't simply about buying cheap assets. It required understanding which properties would recover first and which markets would remain depressed. Blackstone developed sophisticated analytics to evaluate everything from local employment trends to transportation infrastructure to demographic patterns. Their first major crisis-era acquisition was Hilton Hotels Corporation, purchased in 2007 for $26 billion just before the crisis hit. What initially appeared to be terrible timing became a masterclass in crisis management and long-term value creation. As the hospitality industry collapsed and Hilton's revenue plummeted, Blackstone invested additional capital while implementing aggressive cost-cutting measures and operational improvements. The key insight was that business travel and leisure hospitality would eventually recover as economic growth resumed. Hotels were cyclical businesses that generated substantial cash flows during good times while requiring significant capital during downturns. For investors with staying power, the crisis represented an opportunity to acquire dominant market positions at discounted valuations. But the real breakthrough came in single-family housing, a market that Blackstone had never previously considered. As foreclosures accelerated across the United States, millions of homes entered the market through distressed sales, government auctions, and bank liquidations. Traditional homebuyers couldn't obtain financing, while small landlords lacked resources to purchase at scale. The result was an unprecedented opportunity to acquire residential properties at 50 to 70% discounts to peak pricing. Schwartzman's team developed an audacious plan: become America's largest owner of single-family rental properties by purchasing tens of thousands of foreclosed homes across high-growth metropolitan areas. The strategy required building entirely new capabilities for property acquisition, renovation, management, and tenant relations. They needed local expertise in dozens of markets while maintaining centralized oversight of a geographically dispersed portfolio. The execution proved remarkably complex and capital-intensive. Blackstone assembled teams of local real estate professionals who could evaluate properties, arrange acquisitions, and coordinate renovations. They developed standardized processes for everything from tenant screening to maintenance requests. Most importantly, they created financing structures that could support purchases of 100, 200 homes per week across multiple markets simultaneously. The mathematical framework was compelling for investors with patient capital. Single-family homes in desirable locations would eventually recover their pre-crisis values as population growth and household formation resumed. In the meantime, rental income would provide steady cash flows while covering carrying costs and generating modest profits. The combination of rental income and price appreciation promised returns that exceeded other real estate sectors. Their largest acquisition target was Invitation Homes, which would eventually control approximately 80,000 single-family rentals across major metropolitan areas. The scale enabled operational efficiencies that smaller landlords couldn't achieve: bulk purchasing for maintenance and improvements, sophisticated marketing for tenant acquisition, and professional property management systems. Simultaneously, Blackstone was pursuing opportunities in distressed corporate credit and leveraged loans. As companies struggled with declining revenues and tight credit markets, debt securities traded at substantial discounts to face value. Their credit investing team, led by Bennett Goodman, deployed billions in strategies ranging from distressed debt to direct lending for companies that couldn't access traditional bank financing. The credit strategies required different skills than private equity or real estate, but followed similar principles. Identify quality assets trading at discounted prices due to temporary market conditions. Corporate bonds issued by fundamentally sound companies might trade for 60-70 cents on the dollar, simply because forced sellers needed liquidity more than fair value. One particularly successful strategy involved purchasing the debt of companies approaching bankruptcy or reorganization. By acquiring controlling positions in the debt, Blackstone could influence restructuring negotiations and potentially convert debt holdings into equity ownership of valuable assets. This required sophisticated legal and financial analysis, but could generate enormous returns when companies successfully emerged from distress. The energy sector provided additional opportunities as oil prices collapsed and financing for drilling operations disappeared. Blackstone invested in distressed energy companies, oil and gas properties, and energy infrastructure assets that were available at historic discounts. Their energy team correctly anticipated that demand growth would eventually support higher commodity prices and increased drilling activity. What made these investments historically significant wasn't just their profitability, but their scale and systematic approach. Instead of making opportunistic investments in individual assets, Blackstone was acquiring controlling positions in entire market segments. They were effectively betting that American economic fundamentals remained sound despite temporary financial market disruptions. The timing and execution required extraordinary conviction because public criticism of private equity was intensifying during the crisis. Politicians blamed Wall Street greed for causing the financial collapse, while pension funds and university endowments faced pressure to divest from alternative investments. Blackstone's high-profile IPO made them a target for criticism about private equity's role in the crisis. Schwartzman addressed these concerns by emphasizing Blackstone's role in providing capital when other sources disappeared and stabilizing assets that might otherwise deteriorate. Their investments were preventing further economic damage while positioning for eventual recovery. The criticism was politically motivated rather than economically informed. The 2009-2012 period would ultimately prove to be the most profitable in Blackstone's history, as their crisis-era investments generated spectacular returns. Hilton Hotels was eventually taken public at a valuation that doubled their total investment. Invitation Homes became the foundation for a massive single-family rental business. Distressed credit investments returned multiples of original investments as markets recovered and companies emerged from distress. But perhaps most importantly, the crisis established Blackstone's reputation as a counter-cyclical investor with the resources and expertise to deploy capital during market dislocations. This positioning would prove invaluable in future market downturns and would enable them to compete for the largest and most complex investment opportunities across multiple asset classes. Schwartzman had successfully transformed a market crisis into a strategic advantage that would compound for decades. But the scale of their post-crisis success would also attract regulatory attention and political scrutiny that would challenge Blackstone in ways they never anticipated. Chapter 5. Housing Takeover. In 2012, while most Americans were still recovering from the worst housing crash since the Great Depression, Blackstone embarked on the most audacious real estate strategy in modern history, becoming the largest private owner of single-family homes in the United States. What started as an opportunistic investment in distressed properties would evolve into something far more significant: the transformation of American housing from individual ownership to institutional control. The scale of Blackstone's ambition became clear when they announced the acquisition of 1,400 homes in a single week across Phoenix, Arizona. These weren't luxury properties or commercial real estate. They were three-bedroom suburban houses where middle-class families had lived before foreclosure. But Schwartzman saw these properties differently than traditional home buyers. Where others saw individual residences, he saw a portfolio of cash-flowing assets that could be managed like stocks or bonds. The mathematical foundation for this strategy reflected Blackstone's sophisticated approach to alternative investing. Single-family homes offered several compelling characteristics: steady rental income from an essential human need, potential for long-term price appreciation tied to population growth, and operational control over value creation through improvements and professional management. Most importantly, the foreclosure crisis had created temporary pricing dislocations that wouldn't persist as markets normalized. Their initial focus concentrated on Sunbelt metropolitan areas, where population growth exceeded housing supply and rental demand was strengthening. Phoenix, Atlanta, Tampa, Las Vegas, and Charlotte became primary targets due to favorable demographics, employment growth, and relatively affordable property prices. These markets offered the scale necessary for institutional investment while providing attractive yields for patient capital. Jonathan Gray, who led Blackstone's real estate division, recognized that success required building entirely new operational capabilities. Traditional real estate investment focused on commercial properties with sophisticated landlords and experienced property managers. Single-family homes required different expertise, understanding local neighborhoods, managing individual tenant relationships, coordinating maintenance across thousands of properties, and developing systems for acquisitions at unprecedented scale. The execution proved remarkably complex and capital-intensive. Blackstone assembled teams in each target market that combined local real estate knowledge with institutional investment disciplines. They needed professionals who could evaluate neighborhood characteristics, assess individual property conditions, estimate renovation costs, and project rental income, all while processing hundreds of potential acquisitions weekly. Their acquisition strategy evolved rapidly as they learned from early experiences. Initially, they focused on purchasing individual foreclosed properties through traditional real estate channels, but this approach was too slow and expensive for their ambitious scale targets. Instead, they began negotiating bulk purchases directly with banks and government agencies that controlled large portfolios of distressed properties. The breakthrough came through relationships with major banks that needed to liquidate real estate-owned REO properties quickly to comply with regulatory capital requirements. Bank of America, Wells Fargo, and JP Morgan Chase were eager to sell large portfolios to qualified institutional buyers, rather than managing individual property sales through retail markets. These bulk transactions enabled Blackstone to acquire properties at substantial discounts while streamlining due diligence and closing processes. Technology played a crucial role in making this strategy scalable. Blackstone developed sophisticated analytics to evaluate potential acquisitions based on neighborhood characteristics, school quality, employment centers, transportation access, and demographic trends. Instead of relying on local market knowledge alone, they used data science to identify markets and properties most likely to generate superior returns. The renovation and preparation process required standardizing approaches across thousands of properties while maintaining quality standards that would attract desirable tenants. Blackstone developed relationships with regional contractors who could handle large volumes of work, while implementing consistent specifications for everything from flooring and paint to appliances and fixtures. This approach reduced costs while creating predictable timelines for bringing properties to market. Property management at scale presented unique challenges that existing residential management companies couldn't address. Blackstone needed systems for tenant screening, rent collection, maintenance coordination, and lease renewals across dozens of metropolitan areas. They invested heavily in technology platforms that could automate routine functions while providing centralized oversight of property-level performance. The tenant relations strategy reflected careful analysis of rental market dynamics. Rather than maximizing short-term rental income, Blackstone focused on attracting long-term tenants who would care for properties and provide stable income streams. They offered competitive rental rates, professional maintenance services, and responsive customer support that exceeded typical landlord standards. This approach proved successful in attracting working families who had lost homes to foreclosure but remained employed and creditworthy. Many tenants were paying similar amounts in rent to what they had previously paid in mortgage payments, but without the responsibilities and risks of home ownership. For Blackstone, these tenants provided stable income while caring for properties as if they were their own homes. The financial results exceeded expectations as rental income covered operating expenses while property values began recovering. By 2013, Blackstone's single-family rental portfolio was generating positive cash flows while appreciating in value as housing markets stabilized. The combination of current income and price appreciation was producing returns that exceeded most alternative real estate strategies. But success attracted scrutiny from housing advocates, politicians, and researchers who questioned the social implications of institutional ownership of single-family homes. Critics argued that Blackstone's purchases were preventing home ownership opportunities for families, while artificially inflating rental prices in target markets. The concentration of ownership in specific neighborhoods raised concerns about community stability and local political influence. Academic research suggested that large-scale institutional ownership might change the character of residential neighborhoods in concerning ways. Traditional homeowners had strong incentives to maintain properties and engage in community activities since they planned to remain long-term. Institutional owners prioritized financial returns over community engagement, potentially leading to reduced property maintenance and social cohesion. Local politicians in target markets began expressing concerns about outside investors, displacing local homebuyers and driving up housing costs. City councils in Phoenix and Atlanta held hearings about large-scale acquisitions by private equity firms, with some officials proposing restrictions on bulk property purchases by institutional investors. Schwartzman addressed these criticisms by emphasizing Blackstone's role in stabilizing neighborhoods during a period when traditional homebuyers couldn't obtain financing. Their investments prevented further property deterioration while providing quality rental housing for families who needed immediate accommodation. The alternative might have been continued foreclosures and neighborhood decline. The scale metrics were staggering by any historical standard. Within 3 years, Blackstone controlled approximately 50,000 single-family homes across major metropolitan areas, making them larger than most traditional apartment companies. Their Invitation Homes subsidiary became the largest single-family rental operator in the United States, with properties collectively worth more than $10 billion. The The success of single-family rentals validated Blackstone's broader thesis about institutional ownership of residential real estate. Traditional apartment buildings had long been owned by professional investors, but single-family homes had remained primarily owner-occupied. Blackstone demonstrated that professional management and institutional capital could create value in this market while providing essential housing services. More significantly, the strategy established Blackstone as a major force in American housing markets, with influence over rental pricing, neighborhood development, and housing policy. Their scale gave them leverage with local governments, utility companies, and service providers that individual homeowners couldn't achieve. They were effectively creating a new asset class while generating superior returns for their investors. The long-term implications were only beginning to emerge. Blackstone's success encouraged other institutional investors to pursue similar strategies, potentially accelerating the transition from individual homeownership to institutional control. The concentration of rental property ownership in fewer hands could increase market efficiency, but might also reduce competition and tenant protections. For Schwartzman, single-family rentals represented validation of Blackstone's core investment philosophy. Identify essential human needs that aren't efficiently served by existing markets, then use institutional capital and operational expertise to create value for both investors and customers. Housing was the ultimate essential need, and Blackstone had positioned itself to benefit from long-term demographic and economic trends that would drive demand for decades. But the housing strategy would also make Blackstone a target for political criticism and regulatory scrutiny that would intensify as their influence over American housing markets continued expanding. The success that validated their investment approach would also generate opposition from those who viewed institutional ownership of homes as a threat to American values and economic opportunity. Chapter 6. Everything Everywhere. By 2015, Blackstone had transcended its origins as a private equity firm and evolved into something unprecedented, an alternative investment colossus with tentacles reaching into virtually every sector of the global economy. Stephen Schwartzman was no longer simply buying and selling companies. He was systematically acquiring control over the essential infrastructure that powered modern life. The strategy was breathtaking in its scope and audacious in its execution. If people needed it to live, work, or conduct business, Blackstone would own it. The diversification beyond traditional private equity reflected Schwartzman's understanding of how institutional investing was evolving. Pension funds, sovereign wealth funds, and university endowments were allocating increasing percentages of their portfolios to alternative investments, but they wanted access to multiple strategies through single relationships rather than managing dozens of specialized fund managers. Blackstone could provide one-stop shopping for institutions seeking exposure to private equity, real estate, credit, hedge funds, and infrastructure investing. But the expansion was more strategic than opportunistic. Schwartzman recognized that owning complementary assets across related sectors created synergies that enhanced returns and reduced risks. A logistics company became more valuable when Blackstone also owned the warehouses, office buildings, and real estate in the same metropolitan area. An energy company generated higher returns when combined with infrastructure investments in pipelines, storage facilities, and distribution networks. The real estate empire had grown far beyond single-family homes to encompass virtually every property type where people lived, worked, or shopped. Blackstone owned luxury apartments in Manhattan, student housing near major universities, senior living communities, office towers in global financial centers, retail shopping centers, industrial warehouses, hotel chains, and data centers. Their real estate portfolio exceeded $300 billion in value, making them larger than most countries' total real estate markets. Each property sector reflected careful analysis of demographic and economic trends that would drive long-term demand. Student housing benefited from rising college enrollment and parental willingness to pay premium rates for quality accommodations near prestigious universities. Senior living communities would experience explosive demand as baby boomers aged and required specialized care services. Data centers were essential infrastructure for cloud computing and digital transformation across all industries. The logistics and warehouse strategy proved particularly prescient as e-commerce transformed retail and supply chain management. Blackstone had begun acquiring industrial properties in strategic locations near major metropolitan areas years before Amazon's growth made last-mile delivery a business imperative. Their warehouse portfolio included facilities optimally positioned to serve online retailers, manufacturers, and distribution companies serving major population centers. What made this strategy remarkable wasn't just the scale but the systematic approach to identifying and acquiring market-leading positions. Rather than opportunistically purchasing individual properties, Blackstone was building portfolios large enough to influence market dynamics and pricing in target sectors. They weren't simply participating in real estate markets, they were shaping them through the weight of their capital and the sophistication of their operations. The energy and infrastructure investments reflected similar strategic thinking, applied to essential services that societies couldn't function without. Blackstone acquired oil and gas properties, renewable energy projects, pipeline networks, power generation facilities, water treatment plants, and telecommunications infrastructure. These assets generated steady cash flows from essential services while benefiting from long-term demographic and economic growth. Their energy strategy evolved to anticipate the transition from fossil fuels to renewable sources while maintaining exposure to traditional energy during the transition period. Blackstone invested in wind farms, solar projects, and energy storage facilities alongside conventional oil and gas assets. This approach provided upside exposure to clean energy growth while generating current income from traditional sources. The telecommunications infrastructure investments positioned Blackstone to benefit from the exponential growth in data consumption and wireless communications. They owned cell towers, fiber optic networks, and data transmission facilities that were essential for smartphone usage, internet connectivity, and cloud computing services. These assets commanded premium valuations due to their essential nature and high barriers to competitive entry. But perhaps most significantly, Blackstone was systematically acquiring companies that provided essential services across multiple industries. Their corporate private equity portfolio included businesses in healthcare, technology, financial services, manufacturing, and consumer products. The unifying theme wasn't industry sector, but market position. Blackstone targeted companies with dominant market share in essential services that would benefit from long-term growth trends. The healthcare investments reflected the aging of developed economies and rising healthcare consumption across all demographic groups. Blackstone owned hospital systems, medical device manufacturers, pharmaceutical companies, and healthcare services businesses. These investments provided exposure to one of the fastest-growing sectors in developed economies while generating predictable cash flows from essential services. Technology investments focused on infrastructure and business services rather than consumer-facing applications. Blackstone owned cloud computing companies, cybersecurity firms, software development businesses, and technology consulting services. These companies provided essential services to other businesses rather than competing in volatile consumer markets. The financial services investments included insurance companies, asset management firms, payment processing businesses, and specialty finance companies. These businesses generated steady fee income while benefiting from the growth of global financial markets and increasing demand for specialized financial services. What unified these diverse investments was Blackstone's focus on assets that generated predictable cash flows from essential needs while benefiting from secular growth trends. They avoided cyclical businesses dependent on economic conditions in favor of companies serving fundamental human needs that would persist regardless of short-term market fluctuations. The scale of this empire was staggering by any historical measure. Blackstone's assets under management approached $900 billion, larger than the GDP of most countries. Their portfolio companies employed millions of people across dozens of countries. Their real estate assets housed, employed, or served tens of millions of people daily. The decisions made by Blackstone's investment committees affected more lives than those of many elected governments. This concentration of economic power hadn't emerged through hostile takeovers or market manipulation, but through patient capital deployment and superior operational execution. Blackstone consistently outperformed alternative investment benchmarks while providing essential services more efficiently than previous owners. Their success reflected competitive advantages rather than market distortions. But critics began questioning whether any private company should control such vast portions of essential infrastructure. The concentration of ownership in housing, energy, healthcare, and financial services raised concerns about market competition, pricing power, and democratic accountability. When one firm owned significant portions of multiple essential services, their decisions could affect entire communities and economic sectors. Academic researchers noted that Blackstone's influence extended beyond direct ownership to include indirect effects on pricing, competition, and innovation across multiple industries. Their market power in real estate could influence housing costs for both renters and buyers. Their dominance in certain technology sectors could affect innovation and competitive dynamics. Their control over infrastructure could impact access and pricing for essential services. Regulatory attention was increasing as Blackstone's size and influence grew beyond traditional private equity oversight. Banking regulators worried about systemic risk if large alternative investment firms encountered financial difficulties. Housing regulators questioned whether private equity ownership was compatible with affordable housing objectives. Energy regulators examined whether infrastructure concentration threatened market competition. For Schwartzman, these concerns reflected success rather than problems. Blackstone had identified market inefficiencies and deployed capital to create value for both investors and service users. Their scale enabled operational improvements and investment in infrastructure that smaller owners couldn't afford. Criticism was inevitable when established players faced competition from more efficient operators. But Schwartzman also recognized that continued growth required managing political and regulatory risks more carefully. Blackstone's next phase of expansion would need to balance aggressive capital deployment with sensitivity to public policy concerns about market concentration and essential service pricing. The empire they had built was approaching a scale where traditional metrics became inadequate for measurement. They weren't just an investment firm anymore. They had become a parallel economic system with influence comparable to sovereign nations and global corporations. What happened next would determine whether this influence would be used responsibly or would provoke a backlash that could constrain their future growth. Chapter 7: Rent Revolution. By 2018, Blackstone's housing empire had evolved into something that would fundamentally reshape how Americans experienced one of life's most basic needs: shelter. What had begun as an opportunistic investment in foreclosed properties had become a systematic approach to extracting maximum revenue from residential real estate across the United States. The strategy was elegantly simple and devastatingly effective. Buy affordable housing in working-class neighborhoods, renovate the properties to justify higher rents, then gradually replace existing tenants with those willing to pay premium prices. The mathematics were compelling for investors, but troubling for communities. A rental property purchased for $80,000 could be renovated for $15,000 and re-leased at rents 40–60% higher than previous levels. Multiply this process across thousands of properties in dozens of metropolitan areas, and the profit potential became enormous. But the human cost was equally significant: long-term residents displaced, communities gentrified, and affordable housing converted to luxury accommodations. The scale of Blackstone's rental property empire defied comprehension. Through their various subsidiaries and investment vehicles, they controlled over 300,000 residential units across the United States. This included 149,000 apartment units, 63,000 single-family homes, 70 mobile home parks with 13,000 lots, and 144,300 beds in student housing across 205 properties. They had become the largest corporate landlord in human history, with more housing units than many cities. Their Invitation Homes subsidiary alone managed more single-family rentals than the total housing stock of cities like Pittsburgh or Cincinnati. But unlike traditional landlords who operated in single markets, Blackstone's geographic diversification enabled them to implement consistent strategies across multiple metropolitan areas simultaneously. They weren't just competing in local rental markets, they were reshaping them through the weight of institutional capital and systematic operational approaches. The operational sophistication distinguished Blackstone from traditional landlords in ways that maximized revenue extraction. Proprietary algorithms analyzed local market data to optimize rental pricing in real time, adjusting rates based on seasonal demand, neighborhood trends, and competitive properties. Professional marketing attracted higher-income tenants, while screening processes eliminated applicants who might resist rent increases or demand expensive maintenance. Property improvement strategies focused on cosmetic upgrades that justified substantial rent increases without requiring major capital investments. Fresh paint, updated appliances, and modern fixtures could transform a property's market positioning while costing a fraction of structural improvements. The key was identifying modifications that maximized rental income relative to renovation costs. But the most controversial aspect of their strategy involved encouraging tenant turnover to accelerate rent increases. While rent control laws in many states limited annual increases for existing tenants, no restrictions applied when new tenants signed leases. High tenant turnover enabled Blackstone to rapidly adjust rents to market rates while avoiding long-term relationships that might constrain pricing flexibility. Critics documented aggressive tactics designed to encourage voluntary departures by existing tenants. Extensive renovation projects that made properties temporarily uninhabitable, strict enforcement of lease violations that previous landlords had ignored, and delays in addressing maintenance requests that affected tenant comfort. The goal wasn't necessarily eviction, which required legal proceedings and generated negative publicity, but creating conditions where tenants would choose to leave voluntarily. The human impact of these practices became visible in communities across the United States as Blackstone expanded their operations. In San Diego County, their acquisitions resulted in average rent increases of 38% over 3 years, nearly double the market average of 20%. Some properties in historically low-income neighborhoods experienced rent increases approaching 80% as Blackstone repositioned them for higher-income tenants. Community advocates documented the social disruption caused by large-scale displacement of long-term residents. Families who had lived in neighborhoods for decades were forced to relocate when rents exceeded their income. Local businesses lost customers as community demographics changed. Schools experienced enrollment disruptions as families moved away from increasingly expensive neighborhoods. The targeting of specific communities raised concerns about racial and economic discrimination in ways that individual landlords couldn't achieve at scale. Blackstone's acquisitions concentrated in neighborhoods with high percentages of minority residents and working-class families who had limited housing alternatives. The systematic nature of their operations enabled displacement on a scale that surpassed individual instances of gentrification. United Nations housing experts condemned Blackstone's practices as violations of international human rights standards. Their 2019 report concluded that turning homes into financial instruments traded on global markets had devastating consequences for housing affordability and community stability. The report specifically cited Blackstone's rent hiking and eviction strategies as examples of how private equity was worsening housing crises in multiple countries. Academic research confirmed the systemic effects of institutional ownership on rental markets, beyond direct impacts on Blackstone properties. Studies found that large-scale private equity acquisitions increased rental prices for all properties in target neighborhoods, not just those owned by institutional investors. The presence of well-funded professional landlords shifted market dynamics in ways that enabled all property owners to charge higher rents. The concentration of ownership also reduced tenant bargaining power in ways that individual landlords couldn't achieve. When one company controlled significant percentages of available rental housing in specific markets, tenants had fewer alternatives if they faced unreasonable rent increases or poor service. Market competition that theoretically protected tenant interests became ineffective when dominated by a single institutional owner. State and local governments struggled to address problems created by institutional ownership because existing regulations were designed for small-scale individual landlords, not sophisticated financial institutions with unlimited resources for legal and political advocacy. Rent control ordinances could be circumvented through cosmetic improvements that justified exemptions. Tenant protection laws were difficult to enforce against companies with professional legal teams and political connections. The political response varied significantly across different markets and jurisdictions. Progressive cities like San Francisco and New York strengthened tenant protections and imposed restrictions on rent increases. Conservative states like Texas and Florida maintained landlord-friendly regulations that enabled continued rent optimization. The patchwork of local regulations created opportunities for regulatory arbitrage, where Blackstone could concentrate operations in jurisdictions with favorable legal environments. California became a particular focus of political conflict as housing costs reached crisis levels and private equity ownership expanded rapidly. Blackstone spent $725 million opposing Proposition 21, a 2020 ballot measure that would have enabled local communities to implement stronger rent control policies. Their campaign argued that rent restrictions would reduce housing investment and worsen supply shortages. The campaign revealed the political resources that Blackstone could deploy to protect their business model from regulatory constraints. Their opposition research identified community leaders, funded advocacy organizations, and coordinated messaging that framed rent control as harmful to housing development. The sophistication of their political operations matched their investment strategies in effectiveness and scale. Schwartzman addressed criticisms by emphasizing Blackstone's role in improving housing quality and providing professional management services that benefited tenants. Their investments prevented neighborhood deterioration while upgrading properties that had suffered from deferred maintenance under previous owners. Rent increases reflected improvements in housing quality rather than exploitation of market power. But internal communications revealed strategies focused on revenue maximization rather than tenant welfare. Training materials for property managers emphasized techniques for justifying rent increases and minimizing maintenance costs. Performance incentives rewarded employees for achieving rent growth targets rather than tenant satisfaction metrics. The business model's success made expansion inevitable as institutional investors sought exposure to residential real estate returns. Other private equity firms followed Blackstone's example by acquiring apartment buildings, single-family rentals, and manufactured housing communities. The institutional ownership of residential real estate became a recognized asset class with specialized investment vehicles and professional service providers. By 2020, the cumulative effect of institutional ownership was transforming American housing markets in ways that individual property acquisitions couldn't achieve. Rental prices were rising faster than wages in most metropolitan areas, home ownership was declining among younger demographics, and housing costs were consuming increasing percentages of household income for working families. The COVID-19 pandemic intensified these dynamics, as economic disruption increased housing insecurity, while institutional investors continued pursuing acquisition opportunities. Eviction moratoriums provided temporary protection for tenants, but didn't address underlying affordability issues caused by systematic rent increases and conversion of affordable properties to luxury accommodations. For Schwartzman, the housing strategy represented validation of Blackstone's core investment philosophy: identify essential human needs that generate predictable demand, acquire controlling market positions, then optimize operations for maximum returns. Housing was the most essential human need, and Blackstone had positioned itself to benefit from long-term demographic trends that would sustain demand regardless of economic conditions. But the scale of their success was also generating political opposition that threatened future expansion. The next phase of Blackstone's evolution would require navigating increased regulatory scrutiny while maintaining growth in an environment where their influence over essential services was attracting unprecedented public attention and criticism. Chapter 8: Political Power. Stephen Schwartzman understood a fundamental truth about modern capitalism. True power wasn't measured just in dollars, but in the ability to shape the rules that determined how those dollars could be earned. By 2020, as Blackstone's empire approached $1 trillion in assets, Schwartzman had become one of the most influential political actors in American history, wielding more campaign contributions than most corporations and maintaining direct access to presidents, congressional leaders, and regulatory officials across both political parties. The political machine that Schwartzman built was as sophisticated as Blackstone's investment strategies. His personal political contributions exceeded $27 million between 2000 and 2020, making him Wall Street's largest individual donor. But the real influence came through Blackstone's network of political relationships, lobbying expenditures, and policy advocacy that shaped regulatory environments across multiple jurisdictions and asset classes. Unlike tech billionaires who relied primarily on personal charisma or traditional executives who worked through trade associations, Schwartzman deployed political influence with the same systematic approach that made Blackstone successful in alternative investing. He identified key decision-makers, developed long-term relationships, and provided valuable expertise on complex economic issues that few politicians fully understood. The approach transcended partisan politics through careful cultivation of relationships across the ideological spectrum. Schwartzman advised Republican presidents on economic policy while maintaining friendships with Democratic leaders who valued his insights on financial markets and international economics. His ability to work with both parties reflected sophisticated understanding of how American political systems functioned at the highest levels. His relationship with Donald Trump exemplified this pragmatic approach to political influence. Despite fundamental differences in background and temperament, Schwartzman served as chairman of Trump's Strategic and Policy Forum, providing economic advice during the transition period and early presidency. The relationship gave Blackstone access to administration officials while positioning Schwartzman as a trusted advisor on complex financial issues. But Schwartzman's political influence extended far beyond personal relationships to include systematic efforts to shape public policy across multiple areas that affected Blackstone's business operations. Tax policy, financial regulation, housing policy, and international trade rules all received attention through lobbying efforts, campaign contributions, and direct advocacy with elected officials and regulatory agencies. The tax policy advocacy proved particularly valuable as carried interest taxation became a recurring political issue. Carried interest is the share of private equity profits that general partners receive from successful investments, currently taxed as capital gains rather than ordinary income. This treatment reduces tax rates significantly for private equity professionals while generating substantial criticism from politicians seeking additional revenue sources. Schwartzman's defense of carried interest taxation reflected both personal financial interests and philosophical arguments about investment incentives and economic growth. He argued that private equity investments improved company operations, created jobs, and generated tax revenue that exceeded potential losses from preferential tax treatment. The complexity of these arguments required sophisticated political advocacy that went beyond traditional lobbying. The financial regulation advocacy focused on preventing restrictions that could limit private equity operations or impose additional compliance burdens. Banking regulations, securities laws, and investment restrictions all had potential impacts on Blackstone's ability to raise capital, make investments, and generate returns for investors. Schwartzman's political network provided early warning about regulatory proposals while creating opportunities to influence policy development. Housing policy became increasingly important as Blackstone's residential real estate investments attracted criticism from tenant advocates and progressive politicians. Rent control proposals, tenant protection laws, and restrictions on institutional ownership all threatened revenue from Blackstone's housing portfolio. The political response required coordination across multiple jurisdictions while maintaining relationships with officials who might support conflicting policies. His international influence proved equally sophisticated as Blackstone expanded globally and required favorable regulatory treatment in foreign jurisdictions. Schwartzman developed relationships with government officials in Europe, Asia, and Latin America who could facilitate market access while protecting Blackstone's interests through treaty negotiations and regulatory coordination. The Chinese relationship proved particularly valuable as Blackstone pursued investments in one of the world's fastest-growing economies. Schwartzman's personal friendship with Chinese leadership enabled market access that competitors couldn't achieve, while providing insights into economic policy development that informed investment strategies across multiple asset classes. His role in establishing the Schwartzman Scholars Program at Tsinghua University demonstrated sophisticated understanding of soft power and long-term relationship building. The $575 million educational initiative created connections with future Chinese leaders while positioning Schwartzman as a bridge between American and Chinese business communities. The relationships developed through this program provided competitive advantages that couldn't be achieved through traditional business development. The European relationships proved crucial as Blackstone expanded real estate and corporate investments across multiple countries with different regulatory environments. Brexit negotiations, EU investment restrictions, and national security reviews all required political advocacy that combined technical expertise with relationship-based influence. Schwartzman's ability to navigate these complexities enabled Blackstone to complete transactions that other American firms couldn't pursue. But perhaps most importantly, Schwartzman recognized that political influence required providing genuine value to elected officials and policymakers who faced complex decisions with limited expertise. His background in finance and international business enabled him to offer insights that purely academic or bureaucratic advisors couldn't provide. This approach built lasting relationships based on mutual benefit rather than transactional exchanges. The advisory roles extended beyond formal positions to include private consultations on economic policy, crisis management, and international relations. Presidents from both parties sought Schwartzman's views on financial market conditions, regulatory policy, and economic development strategies. His advice was valued because it reflected practical experience managing large-scale investments rather than theoretical knowledge. The crisis management experience proved particularly valuable during economic downturns, when government officials needed insights into private market conditions and potential policy responses. Schwartzman's perspective during the 2008 financial crisis, COVID-19 pandemic, and various international crises provided unique insights that informed policy decisions affecting millions of people. But the political influence also generated criticism from those who questioned whether private investors should have such direct access to policymakers and regulatory officials. Progressive activists argued that Schwartzman's political contributions and advisory roles created conflicts of interest that prioritized private profit over public welfare. The revolving door between Blackstone and government positions raised additional concerns about regulatory capture. Academic researchers documented the correlation between Schwartzman's political contributions and favorable regulatory decisions affecting private equity taxation, financial regulation, and housing policy. While direct causation was difficult to prove, the pattern suggested that political influence was generating tangible benefits for Blackstone's business operations and investor returns. The international influence raised concerns about American foreign policy being shaped by private business interests rather than national security considerations. Critics questioned whether Schwartzman's relationships with foreign leaders created conflicts between his advisory roles and his fiduciary responsibilities to Blackstone investors, particularly sovereign wealth funds from potentially adversarial nations. Schwartzman addressed these criticisms by emphasizing his commitment to American economic interests and his belief that private sector expertise improved government decision-making. His political involvement reflected civic responsibility rather than narrow self-interest, and his advice consistently supported policies that would strengthen American competitiveness in global markets. The regulatory response to these concerns remained limited due to the complexity of modern political influence and the difficulty of proving inappropriate coordination between political contributions and policy outcomes. Existing ethics rules focused on direct quid pro quo arrangements rather than the sophisticated relationship-based influence that characterized modern lobbying and advocacy. For Schwartzman, political influence represented an essential component of long-term value creation that protected Blackstone's ability to generate superior returns for investors. The alternative wasn't political neutrality, but reduced influence over policies that could significantly impact investment returns and business operations. Effective advocacy was as important as effective investing for achieving sustainable competitive advantages. But the scale of Blackstone's political influence was also approaching levels that could provoke backlash from those who viewed concentrated private power as incompatible with democratic governance. The next phase of Schwartzman's political evolution would require balancing continued advocacy for favorable policies with sensitivity to public concerns about excessive private influence over public decisions. The political empire he had built was becoming as powerful as his financial empire, but it was also attracting attention that could constrain both if not managed carefully. Chapter 9: Global Empire. By 2021, Blackstone's expansion beyond American borders had transformed the firm into a global financial empire with influence that transcended national boundaries and reshaped international capital markets. Stephen Schwartzman's vision of controlling essential infrastructure and services was no longer limited to the United States. It encompassed a worldwide network of assets spanning 6 continents and dozens of countries, each offering unique opportunities to apply Blackstone's systematic approach to alternative investing. The international expansion reflected Schwartzman's understanding that demographic and economic trends creating investment opportunities in the United States were occurring globally at different speeds and scales. Aging populations in developed countries created demand for senior living facilities and healthcare services. Urbanization in emerging markets generated opportunities in logistics, housing, and infrastructure. Technological transformation required data centers, telecommunications networks, and digital infrastructure across all economies. Europe became Blackstone's first major international expansion target due to market similarities with the United States and regulatory frameworks that enabled institutional investment. The European Union's large integrated economy provided scale opportunities while individual countries offered specialized expertise in sectors where Blackstone could add value through operational improvements and capital investment. Their European real estate strategy focused on logistics properties serving e-commerce growth, urban housing facing supply constraints, and commercial properties in prime locations that could benefit from professional management. The approach proved remarkably successful as European markets exhibited many characteristics that had made American investments profitable: institutional ownership gaps, operational inefficiencies, and regulatory environments that favored patient capital. The logistics investments proved particularly prescient as European e-commerce growth accelerated and supply chain efficiency became a competitive necessity for retailers and manufacturers. Blackstone acquired warehouse networks in strategic locations near major population centers, creating platforms that could serve multiple markets while benefiting from increasing demand for last-mile delivery services. But their housing investments in Europe generated controversies that foreshadowed criticism they would face globally. In Sweden, Denmark, and Germany, Blackstone acquired large portfolios of rental properties that they repositioned for higher-income tenants through renovation and rent increases. The strategy was similar to their American approach, but faced stronger political opposition from governments committed to affordable housing and tenant protections. The Swedish experience exemplified both the opportunities and risks of international expansion. Blackstone acquired approximately 20,000 residential units through their acquisition of the Carnegie portfolio, making them one of Sweden's largest residential landlords. Their operational improvements and capital investments upgraded properties that had suffered from deferred maintenance while implementing professional management systems that improved tenant services. But the rent increases and tenant displacement that accompanied these improvements generated intense political controversy. Swedish housing advocates accused Blackstone of prioritizing profits over social responsibility, while government officials questioned whether foreign investors should control essential housing infrastructure. The criticism culminated in regulatory changes that restricted private equity operations in residential real estate. The German and Danish experiences followed similar patterns as Blackstone's systematic approach to rent optimization conflicted with cultural expectations about housing as a social good rather than purely commercial asset. In Copenhagen, rent increases of up to 400% after Blackstone acquisitions generated political backlash that led to new regulations limiting institutional ownership of residential properties. These controversies taught Schwartzman valuable lessons about the importance of cultural sensitivity and political engagement when operating across different regulatory and social environments. Success required adapting Blackstone's operational strategies to local expectations while maintaining the systematic approaches that generated superior returns. The Asian expansion proved more complex due to cultural differences, regulatory restrictions, and varying stages of economic development across different countries. But the opportunities were also enormous, as rapid economic growth created infrastructure needs that exceeded local capital availability and expertise. Blackstone's resources and operational capabilities could accelerate development while generating attractive returns for investors. China became their most important Asian market due to its size, growth rate, and government policies that encouraged foreign investment in specific sectors. Schwartzman's personal relationships with Chinese leadership, developed through the Schwartzman Scholars Program and direct diplomacy, provided access that competitors couldn't achieve while enabling navigation of complex regulatory requirements. Their Chinese investments focused on logistics, healthcare, and technology sectors, where government policies supported foreign participation and growth potential exceeded regulatory risks. The scale opportunities were unprecedented as China's economy required infrastructure development that dwarfed needs in developed markets while generating returns that reflected rapid economic expansion. But operating in China also required understanding political risks that didn't exist in democratic countries with independent legal systems. Regulatory changes could eliminate entire investment strategies overnight, while political tensions between China and the United States could affect asset values and operational flexibility. Schwartzman's diplomatic approach proved crucial for managing these risks while maintaining access to lucrative investment opportunities. The Indian market presented different challenges and opportunities as democratic institutions and English-language business culture facilitated operations, while regulatory complexity and infrastructure limitations created operational difficulties. Blackstone's investments focused on real estate, technology, and financial services sectors, where their operational expertise could create value while benefiting from India's economic development. Their Indian real estate investments proved remarkably successful as urbanization and economic growth generated demand for commercial space, residential housing, and logistics facilities. The scale of development needs exceeded local capital availability, while regulatory reforms were encouraging foreign investment in real estate and infrastructure projects. The technology investments reflected India's emergence as a global center for software development and digital services. Blackstone acquired stakes in Indian technology companies that served both domestic markets and international clients, providing exposure to one of the world's fastest-growing technology ecosystems while generating dollar-denominated revenues that reduced currency risks. But perhaps most importantly, the global expansion established Blackstone as one of the few investment firms with the scale and expertise to deploy capital across multiple countries and asset classes simultaneously. This capability became increasingly valuable as institutional investors sought exposure to global growth opportunities while managing risks through geographic and sector diversification. The coordination required for global operations pushed Blackstone to develop systems and processes that could function across different time zones, currencies, legal systems, and cultural environments. Their technology platforms, operational procedures, and investment analysis capabilities became more sophisticated as they adapted to serve markets with vastly different characteristics. The talent acquisition and development also became more complex as Blackstone recruited professionals who could operate effectively in international markets while maintaining alignment with corporate culture and investment standards. Language skills, cultural knowledge and regulatory expertise became as important as financial analysis and operational capabilities. The scale metrics by 2021 were staggering by any historical measure. Blackstone operated in more than 40 countries across 6 continents, with assets under management approaching $1 trillion. Their portfolio included properties and companies in virtually every major economy, making them one of the largest private owners of real estate and business assets in human history. But the global expansion also created new risks and challenges that required constant attention from senior leadership. Political changes could affect multiple markets simultaneously, while economic disruptions could propagate across their diverse portfolio in unexpected ways. Currency fluctuations, trade tensions, and regulatory coordination added complexity that purely domestic operations avoided. For Schwartzman, the global empire represented the logical evolution of Blackstone's systematic approach to identifying and capitalizing on essential human needs. The same demographic and economic trends that created opportunities in American markets were occurring worldwide at different speeds and scales, providing virtually unlimited opportunities for patient capital and operational expertise. But success at global scale also attracted attention from international organizations, foreign governments, and advocacy groups who questioned whether any private firm should control such vast portions of essential infrastructure across multiple countries. The power that enabled superior returns was also generating political opposition that could constrain future expansion if not managed carefully. The next phase of Blackstone's evolution would require balancing continued international growth with sensitivity to concerns about concentrated private control over essential services and infrastructure. The global empire that Schwartzman had built was approaching a scale where traditional business considerations would need to account for broader geopolitical and social implications. Chapter 10. Modern Controversy. By 2022, Blackstone had achieved something unprecedented in the history of capitalism. They had simultaneously become the world's most successful alternative investment firm and its most controversial corporate entity. With over $1 trillion in assets under management, Stephen Schwartzman's empire touched virtually every aspect of modern life, while generating criticism from sources as diverse as United Nations human rights experts, progressive politicians, tenant advocacy groups, and academic researchers studying market concentration and economic inequality. The scale of criticism reflected the scale of Blackstone's influence across sectors that affected millions of people daily. Their housing investments controlled rent costs for hundreds of thousands of families. Their healthcare investments influenced medical services access and pricing. Their technology investments affected digital infrastructure and data privacy. Their energy investments shaped environmental policies and climate change responses. No private company in history had simultaneously controlled such vast portions of essential infrastructure while operating across so many jurisdictions. The housing criticism reached its most intense level when United Nations Special Rapporteurs on the Right to Adequate Housing published a scathing report that specifically named Blackstone as a threat to international human rights. The report concluded that private equity ownership of residential real estate was incompatible with the human right to housing and called on governments to regulate institutional ownership of rental properties. Dr. Leilani Farha and Dr. Surya Deva, the UN experts who authored the report, documented systematic patterns of rent increases, tenant displacement, and community disruption across multiple countries where Blackstone operated housing investments. Their research found that Blackstone's buy it, fix it, sell it model prioritized financial returns over housing stability in ways that violated international human rights standards. The UN report highlighted specific cases where Blackstone's operations had generated displacement and affordability crises. In San Diego County, their acquisitions resulted in average rent increases of 38% compared to market averages of 20%. In European markets, rent increases of 400% following Blackstone acquisitions forced long-term residents from neighborhoods they had called home for decades. Academic research supported these criticisms with empirical analysis, demonstrating that large-scale institutional ownership changed rental market dynamics in ways that increased housing costs for all residents, not just those living in privately equity-owned properties. Studies found that Blackstone's presence in metropolitan markets was correlated with accelerated rent growth and reduced affordability across entire metropolitan areas. The research methodology was particularly damaging because it relied on objective data analysis rather than anecdotal complaints. Housing economists used property-level rent data, demographic information, and ownership records to demonstrate statistically significant relationships between private equity ownership and rent increases that exceeded market trends and wage growth. Dr. Elora Raymond at Georgia Institute of Technology published research showing that single-family rental companies like Invitation Homes charged rents 7% higher than comparable properties owned by individual landlords while providing equivalent or inferior maintenance services. The rent premium reflected market power rather than superior service delivery, suggesting that institutional ownership enabled price increases that individual landlords couldn't achieve. But the criticism extended far beyond housing to encompass Blackstone's influence over healthcare, education, and essential services. Progressive politicians like Senator Elizabeth Warren repeatedly highlighted how private equity ownership of hospitals, nursing homes, and medical practices prioritized profits over patient care while increasing healthcare costs for families and government programs. The healthcare criticism focused on documented patterns of cost-cutting, staff reductions, and service limitations at medical facilities acquired by private equity firms. Academic studies found higher patient mortality rates, increased complications, and reduced staff satisfaction at hospitals and nursing homes following private equity acquisitions compared to facilities that remained under traditional ownership. Warren's research showed that private equity ownership of healthcare facilities increased costs for Medicare and Medicaid programs while reducing service quality for vulnerable populations who relied on public insurance programs. The criticism resonated politically because healthcare costs affected every American family, while private equity profits seemed to come at the expense of patient welfare. The environmental criticism emerged from Blackstone's substantial investments in fossil fuel companies, carbon-intensive real estate, and energy infrastructure that contributed to climate change. Environmental advocacy groups documented how Blackstone's capital enabled continued operation of coal plants, oil drilling operations, and manufacturing facilities that violated environmental regulations or resisted clean energy transitions. Climate activists organized protests at Blackstone's offices and Schwartzman's public appearances, demanding divestment from fossil fuel investments and commitment to environmental sustainability standards. The protests attracted media attention that highlighted contradictions between Schwartzman's philanthropic support for education and environmental research and his firm's investments in companies that contributed to climate change. The political criticism intensified during the 2020 presidential campaign as Democratic candidates competed to propose policies that would constrain private equity operations and reduce their influence over essential services. Proposals included eliminating carried interest tax benefits, restricting institutional ownership of housing, and increasing regulatory oversight of systemically important financial institutions. Senator Warren proposed legislation that would hold private equity firms liable for the debts and legal violations of their portfolio companies, effectively making Blackstone responsible for the actions of businesses they controlled. The proposal would have fundamentally changed private equity business models by eliminating limited liability protections that enabled aggressive cost-cutting and risk-taking by portfolio companies. The regulatory scrutiny increased as Blackstone's size approached levels that could create systemic risks for financial markets if their operations were disrupted. The Financial Stability Oversight Council designated Blackstone as a systemically important financial institution, subject to enhanced supervision and capital requirements similar to those applied to major banks. But perhaps most significantly, the criticism was beginning to affect Blackstone's operations and investment opportunities as political opposition translated into regulatory restrictions and investor reluctance. Some pension funds faced political pressure to reduce private equity allocations, while universities and other institutions reconsidered their alternative investment strategies in response to public criticism. European governments implemented restrictions on private equity ownership of residential real estate, that forced Blackstone to modify their business models or exit certain markets entirely. The German and Swedish regulatory changes demonstrated how political opposition could eliminate entire investment strategies, even when they generated superior returns for investors. Schwartzman's response to these criticisms reflected his characteristic blend of defiance and pragmatism. He argued that Blackstone's investments improved operational efficiency, created jobs, and generated tax revenue that exceeded any negative externalities. Critics were politically motivated rather than economically informed, and their proposed restrictions would ultimately harm workers and communities that benefited from Blackstone's capital and expertise. The defense emphasized Blackstone's role in providing capital when other sources weren't available and improving assets that had suffered from underinvestment or poor management. Their housing investments upgraded properties that had deteriorated under previous ownership, while their healthcare investments provided capital for facility improvements and technology upgrades. But Schwartzman also recognized that continued growth required addressing legitimate concerns about market concentration and social responsibility. Blackstone began implementing environmental, social, and governance (ESG) standards for their investments, while establishing committees to evaluate potential social impacts of their strategies. The ESG initiatives included commitments to achieve net zero carbon emissions across their portfolio by 2050, implement diversity and inclusion standards for portfolio companies, and establish tenant protection policies for their housing investments. These changes reflected both genuine commitment to social responsibility and pragmatic recognition that sustainable business practices would be necessary for long-term success. However, critics questioned whether voluntary ESG commitments would meaningfully constrain profit-maximizing behaviors that had generated criticism. Without regulatory requirements or investor mandates, private equity firms retained incentives to prioritize financial returns over social and environmental considerations when conflicts arose. The controversy surrounding Blackstone reflected broader concerns about wealth concentration, market power, and democratic accountability in modern capitalism. Their success demonstrated that patient capital and operational expertise could generate superior returns while providing essential services more efficiently than previous ownership structures. But their influence also raised fundamental questions about whether essential infrastructure and services should be controlled by private investors whose primary obligation was maximizing returns for wealthy institutions rather than serving broader public interests. For Schwartzman, these concerns represented the inevitable challenges of success in a democratic society where economic power generated political attention and regulatory scrutiny. Managing these challenges would require the same systematic approach that had made Blackstone successful in alternative investing: understanding stakeholder interests, developing long-term relationships, and adapting strategies to changing political and social environments. Chapter 11: Future Control. As 2023 unfolded, Stephen Schwartzman was already positioning Blackstone for the next phase of global expansion, one that would make their previous achievements seem modest by comparison. At 76 years old, with a personal fortune exceeding $37 billion, Schwartzman wasn't planning retirement, but rather the most ambitious transformation in Blackstone's 38-year history. Evolution into a diversified financial services company capable of competing with traditional banks while maintaining the operational advantages that had made alternative investing so profitable. The strategic vision reflected Schwartzman's analysis of how technology, demographics, and climate change would reshape global markets over the next 2 decades. Artificial intelligence would require massive investments in computing infrastructure and data centers. Aging populations would drive demand for healthcare facilities and senior living communities. Climate change would necessitate trillions in clean energy infrastructure while creating stranded assets in fossil fuel industries. Most importantly, these trends would generate investment opportunities too large and complex for traditional financial institutions, while requiring operational expertise that purely financial investors couldn't provide. Blackstone's combination of patient capital, global scale, and industrial knowledge positioned them to dominate markets that didn't yet exist but would become essential components of 21st-century infrastructure. The artificial intelligence investments represented Schwartzman's most ambitious bet on technological transformation. Blackstone was systematically acquiring data centers, cloud computing companies, semiconductor manufacturers, and artificial intelligence software firms that would provide the infrastructure for AI-driven economic transformation. The strategy reflected understanding that AI would require physical infrastructure investments measured in trillions of dollars rather than billions. Their data center portfolio was already approaching $50 billion in value as demand for computing infrastructure exceeded supply across major metropolitan areas. The investments ranged from traditional server facilities to specialized installations designed for machine learning and artificial intelligence applications that required enormous amounts of processing power and energy consumption. But the AI strategy extended beyond infrastructure to include investments in companies developing artificial intelligence applications for specific industries. Healthcare AI, financial services automation, manufacturing optimization, and logistics coordination all represented opportunities where AI could generate enormous productivity improvements while creating new revenue streams for companies with proprietary algorithms and datasets. The climate infrastructure investments reflected similar long-term thinking about transformation that would require massive capital deployment over decades. Blackstone was positioning to become one of the world's largest owners of renewable energy generation, battery storage systems, electric vehicle charging networks, and carbon capture technologies. Their renewable energy portfolio included wind farms, solar installations, and hydroelectric facilities across 6 continents, with combined generating capacity that exceeded many national electricity systems. But they were also investing in next-generation technologies like offshore wind, concentrated solar power, and advanced geothermal systems that could provide baseload renewable electricity. The energy storage investments targeted battery facilities, pumped hydro storage, and compressed air systems that could provide grid stability as renewable energy generation increased. These facilities generated revenue from multiple sources, including energy arbitrage, grid services, and backup power provision, while becoming increasingly valuable as renewable energy penetration increased. Perhaps most significantly, Blackstone was investing in carbon capture and storage technologies that could enable continued operation of existing fossil fuel infrastructure while meeting climate change targets. These investments hedged their traditional energy holdings while providing exposure to potentially enormous revenue streams if carbon pricing became globally implemented. The healthcare and aging demographic investments reflected systematic analysis of how population aging would drive demand for specialized facilities and services over the next 3 decades. Blackstone was acquiring senior living communities, medical office buildings, specialty hospitals, and healthcare technology companies positioned to serve aging populations with increasing medical needs and financial resources. Their senior living strategy focused on luxury facilities serving affluent retirees willing to pay premium prices for high-quality accommodations and comprehensive medical services. These facilities generated higher profit margins than traditional nursing homes while serving demographic groups with substantial accumulated wealth and long-term care insurance coverage. But they were also investing in medical technology companies developing treatments and devices specifically designed for age-related conditions. Alzheimer's research, joint replacement technologies, cardiac care systems, and home healthcare services all represented growth opportunities driven by demographic trends rather than economic cycles. The financial services transformation represented Schwartzman's most ambitious strategic initiative, evolving Blackstone from an alternative investment manager into a diversified financial institution capable of competing with traditional banks across multiple business lines. The strategy leveraged their existing relationships with institutional clients while adding retail investment services, corporate lending, and insurance products. Their credit business was already approaching $300 billion in assets, as companies increasingly relied on private lending rather than traditional bank financing for complex transactions. Blackstone's ability to provide large-scale debt financing gave them competitive advantages in acquiring businesses and real estate, while generating steady fee income from lending operations. The insurance strategy involved acquiring life insurance companies and annuity providers that needed investment expertise to generate returns sufficient for meeting policyholder obligations. Insurance companies provided stable, long-term capital that aligned perfectly with Blackstone's investment approach, while enabling expansion into retail financial services markets. But the most transformative initiative was developing technology platforms that could provide wealth management services to high-net-worth individuals and institutions seeking access to alternative investments. Traditional private wealth management focused on stocks, bonds, and mutual funds, while alternative investments remained accessible only through specialized relationships with private equity firms. Blackstone's technology platform would democratize access to alternative investments, while maintaining the operational advantages that generated superior returns. Individual investors could allocate portions of their portfolios to real estate, private equity, and credit strategies through professionally managed vehicles that provided liquidity and diversification benefits. The global expansion continued accelerating as emerging markets offered infrastructure development opportunities that exceeded capital availability while providing returns that reflected rapid economic growth. Africa, Latin America, and Southeast Asia all presented massive investment needs in transportation, energy, telecommunications, and urban development that aligned with Blackstone's capabilities. Their African investments focused on logistics infrastructure, telecommunications networks, and financial services companies serving rapidly growing economies with young demographics and increasing urbanization. The opportunities were enormous, but required local partnerships and political relationships that took years to develop while providing potential returns that exceeded developed market alternatives. The Latin American strategy concentrated on Mexico and Brazil, where proximity to the United States and large domestic markets provided scale opportunities similar to their successful Asian expansion. Infrastructure investments, real estate development, and corporate acquisitions all offered attractive returns, while benefiting from trade relationships and demographic trends. But perhaps most importantly, Schwartzman was preparing for potential disruptions that could threaten Blackstone's business model if not anticipated and managed proactively. Regulatory restrictions on private equity operations, tax changes affecting carried interest, and political opposition to institutional ownership of housing all represented risks that could significantly impact future returns. The succession planning also required addressing how Blackstone would maintain its culture and investment approach as Schwartzman transitioned from active leadership to advisory roles. The firm had grown beyond dependence on any single individual, but Schwartzman's vision and relationships remained crucial for accessing the largest and most complex investment opportunities. Jonathan Gray, who had emerged as Schwartzman's likely successor, brought different skills and perspectives that would shape Blackstone's evolution in ways that reflected generational changes in finance and business leadership. Gray's focus on operational excellence and technology integration complemented Schwartzman's relationship building and strategic vision while preparing Blackstone for leadership transition. For Schwartzman, the future represented both vindication of Blackstone's systematic approach to alternative investing and recognition that continued success required constant adaptation to changing market conditions and stakeholder expectations. The empire he had built over 4 decades was approaching a scale and influence that exceeded his original vision, while facing challenges that required all the strategic thinking and operational excellence that had enabled their historic success. The next phase would determine whether Blackstone could maintain its position as the world's dominant alternative investment firm, while adapting to technological, regulatory, and social changes that would reshape global finance over the next generation. Chapter 12. $1 Trillion. On a crisp October morning in 2024, Stephen Schwartzman stood before Blackstone's quarterly investor call and delivered news that would redefine the boundaries of private investment. Blackstone had officially crossed $1.2 trillion in assets under management, making it larger than most national economies and more influential than many sovereign governments. The number wasn't just a financial milestone, It represented the culmination of a 39-year journey that had transformed two unemployed executives into controllers of the global economic infrastructure. The mathematical scale defied comprehension by traditional business metrics. Blackstone's assets exceeded the gross domestic product of Spain, Canada, or Russia. Their real estate portfolio alone was worth more than the market capitalization of Apple. Their private equity holdings controlled companies employing millions of people across 6 continents. Their credit investments provided financing for businesses when traditional banks couldn't or wouldn't lend. They had become a parallel economic system operating alongside but independent of national governments and central banks. But the trillion-dollar milestone represented more than accumulation. It marked a transformation of capitalism itself into something unprecedented in human history. Traditional distinctions between public and private ownership had blurred as Blackstone acquired essential infrastructure that governments once controlled directly. The boundary between financial markets and physical reality had dissolved as their investments encompassed everything from housing and healthcare to energy and transportation. The portfolio composition revealed the breadth of their influence across sectors that touched every aspect of human life. Real estate investments worth $400 billion included apartment buildings, office towers, warehouses, data centers, hotels, student housing, senior living facilities, and single-family homes across dozens of countries. Corporate private equity investments of $350 billion controlled companies providing healthcare, technology services, manufacturing, energy, and financial services to hundreds of millions of people. Credit investments approaching $300 billion provided financing for businesses, ranging from small manufacturers to multinational corporations that couldn't access traditional bank lending due to size, complexity, or risk profile. Infrastructure investments exceeded $100 billion in assets, including transportation networks, telecommunication systems, energy generation and distribution, water treatment facilities, and digital infrastructure that enabled modern economic activity. The geographic distribution demonstrates